If you're wondering whether or not to purchase permanent life insurance, like whole life or universal life, then keep watching this video to find out whether they're the right choice for you or not. When you're considering permanent life insurance, you should first analyze if you're buying it corporately or personally. If your corporation has excess retained earnings that you don't plan on paying out or reinvesting, then maybe permanent insurance is a good idea for you. The benefit of having permanent insurance is that it's the only investment opportunity where you can earn dividends tax-free corporately. On top of that, it doesn't impact the grind on small business deductions, like other passive investments. If the insurance is structured well, the death benefits may credit the capital dividend account, which leads to a large tax-free dividend that can be distributed to family members and shareholders. However, there's also some risks to permanent insurance. The main risk is called the premium continuity risk. This risk occurs when the business fails to succeed and premiums are still due. With this in mind, you could lose your principal, and this could be a terrible strategy for you to build wealth. Now, let's move on to personal use. When you have a permanent life insurance policy, you need to be earning a good and steady income or be on track for a successful career. If you're someone who has a family history of illnesses or you have a high-risk lifestyle, then permanent life insurance may be the right choice for you. But just because you have a permanent life insurance policy doesn't mean you should stop contributing to your other tax shelters like your RRSP and tax-free savings accounts. These tax shelters are still very beneficial for you and definitely should be prioritized above and beyond wealth building through a permanent insurance policy. There are similar risks personally as to corporately, as you can lose your principal capital if you're unable to pay for the premiums. If this were to occur, you'd typically be able to surrender and withdraw some cash value. However, this strategy is not recommended as it's not a winning investment strategy. The second risk of getting permanent life insurance is not fully understanding what you're buying. You should never get into a long-term strategy without fully understanding what the terms are. For example, the most common policy sold is annual renewable term for universal life. It's cheaper when you're young, but if you haven't built up sufficient cash reserves in the policy, this could likely lapse as you get older as the cost of insurance increases. To summarize everything I've mentioned, everyone's situation is different. Term insurance can be a totally viable solution, but you should be aware of purchasing the cheapest product that may not have solid conversion privileges. Know what you're getting into so that you can avoid giving over half of your investment income to the Canadian government. Thanks for watching, and we'll see you again soon.